Hi, everybody. First off, Happy New Year. Hopefully, the year 2021 brings us some good news on the health front, and hopefully, life starts getting back to normal. I know that I'm very ready for that to happen, as I'm sure all of you are. So, here's to a better year for everybody. Thanks for joining us for the third session of Retiring with Confidence. It's really important in this series that you view the prior series because the prior episodes, because each one is going to build on the prior episodes and we'll get fairly advanced fairly quickly. So if you're lost, go back, watch the last couple episodes, and then come back and watch this again. All of them are available on our YouTube channel. And uh, if I could just ask everyone to mute, thanks. The other thing is, we're pretty excited. We're working on a tool which is going to help automate a lot of this for our members so that you don't actually have to do the work in Excel. You'll just get the answers efficiently and quickly. But it's very good to understand and play around with the Excel yourselves. So stay tuned for that. I'm really hopeful we can get that out soon. And that'll be something that really is beneficial for managing your finances. But really understanding the concepts and all are a prerequisite to making sure you use these tools correctly. So let's get started with today. So before we do that, a quick recap of last time. We discussed corpus management, monitoring, and tracking. So the corpus is the lifeblood of your finances post retirement. It's the raw materials. And analyzing your corpus and managing it and monitoring it and tracking it is going to determine how well you're able to use that raw material to generate a comfortable retirement for yourself. So we built a simple spreadsheet to help us do some analysis, and we're going to keep working on improving our spreadsheet as we learn more and more of the concepts and tools that we need to do to effectively manage our finances. So we also briefly introduced the topic of today, which is risk. So everything we covered last time was around return and asset allocation from that lens, right? But that's only half the picture. The other picture is risk. And that's what we're going to start covering today. And in the next session, we'll conclude on the risk topic. But there's a lot of good stuff in today's session. So let's get started. So what are we going to cover exactly today? We're going to understand what risk means in the context of our corpus investments. When people say risk, what does that mean? Risk of what? We're going to discuss how we try to estimate risk when we do analysis on our investments. And we're going to try to incorporate a risk estimate into our spreadsheet and work. So what exactly does someone mean when they say risk in the context of an investment? When someone just says risk, it really is a meaningless phrase because there has to be a risk of something. And in finance, we generally talk about various subcategories of risk. There are three main ones. So the first one is, what is the risk my investment goes bust? So the simple analogy of this is, let's say you invest in a store and the store goes out of business, right? That's the kind of risk we're talking about here. This is sometimes called credit risk, default risk, solvency risk, but essentially they're all dealing with the same concept. What happens if the investment gets written off completely? The second risk is, what is the risk of the market being bad when I need to sell? As we've seen, the stock market moves up and it moves down. Housing markets move up and they move down. And even if the investment doesn't go to zero, there is still a risk that I need to sell when the market is bad, right? And that's what we call liquidity risk or volatility risk. And that, in a large way, is the kind of risk we're going to be talking a lot about today. The third kind of risk that's very important for our fixed returns is something called inflation risk or interest rate risk. So when we invest in debt, a fixed deposit, or any form of debt that pays us a fixed coupon, a fixed amount every year, an annuity, we are wagering that that return will be good enough in the future. And that may or may not be the case if inflation tends to be higher than what we expected, or if interest rates move higher than what we had expected. That is a risk that we are taking when we enter into fixed instruments. We're going to talk a lot about this later when we covered fixed fixed income instruments, including annuities, bonds, debt mutual funds, all of those things. So that we'll cover later. The real risk we're going to be focused on here is liquidity risk. So before we get into liquidity risk, diversification has an important impact on our ability to manage risk. And the reason liquidity risk is so important, volatility risk is so important, is that you can diversify a lot of your credit risk and default risk away and make that very, very small. If you invest in the Nifty index, for example, sure, maybe one or two companies in the index may go bust if something really bad happens, right? But it's unlikely that every company is going to go bust. So that's how diversification can very, very significantly eliminate credit risk. But liquidity risk is something which you can see even the Nifty and the amount of swings that the Nifty price has, there's still a lot of volatility risk in the overall stock market and overall housing prices, etc. So this is a risk that we cannot diversify all of it away. And so we really need to understand this risk carefully. So let's try to understand this risk conceptually. What does it mean? Like why is this such a risk? So let's assume our corpus was invested 100% in equities. We're retired. We opted for an index fund to heighten our diversification. So we said, we don't want to take too much risk. So we'll put it all in an index fund. And I opted for the growth option because I knew that maximized my return. And I have no cash income coming in. So that means I'm going to have expenses and I need to fund those expenses through periodic sales of my corpus. And we can see that what happened this year, right? So here I have a chart of the Nifty, right, over the last 12 months. And you can see that for a good 6 to 7 months, the price of the Nifty was significantly below what it was at the beginning of the year. And so because I was relying on my corpus to fund my expenses, I was forced to sell at prices that were below where I wanted to sell. And so that's really what we're talking about when we're talking about liquidity and volatility risk. Even if you know an investment is going to recover, it doesn't matter if you need to sell it to cover your expenses. So that's kind of what the risk we're talking about is. So what approach are we going to take to quantify this? Well, volatility is a measure of how much the prices of our investments tend to move up or down. So for most of our investments, we have a lot of historical price data. And this is very true of anything that deals with the markets. So we're talking about mutual funds here that publish NAVs. We're talking about small cases that publish NAVs. We're talking about stocks that you can get real-time quotes on a minute-by-minute basis. Anything that has lots and lots of price data, you can quantify how much the prices historically tend to move up or down. And this is not as true for something like real estate, for example, because you don't get a minute by minute quote on your home value. But for things that are listed and deal in the markets, this is a very, very good tool. So we'll use something called the standard deviation formula to measure the average volatility of these assets. And that's the tool that we use to figure out how much volatility our investments carry. And I'm going to show you how to use that tool and how powerful it can be. And we're going to incorporate this into our Excel ledger to get a sense of how much our investments can move on a year-to-year basis. So we'll know how much risk, how much volatility risk are we taking with each of our investments. And that's going to enable us to invest better and find investments that more accurately match the amount of volatility that we're willing to take in our lives. So before we get to how to use it, I want to just cover how it works. So essentially, conceptually, what we're doing when we're looking at the standard deviation is we're comparing the average daily return relative to what actually happened during the day. So let's say I had 365 days of data on the price of Reliance stock. And let's say on average, the daily return for that period was 0.25%. That means every day the stock gained on average 0.25%. But we've all seen CNBC and we've seen how much the stocks can move up and down on a daily basis. So we know that Reliance didn't move up 0.25% every day, right? Some days it was up 1%, some days it was down 1%, some days it was up 0.5%, some days it was down 0.25%. So what the standard deviation formula does is it calculates the average distance from the average daily return for the data. So stocks that deviate more from the average tend to be considered more volatile. So that's what we're measuring when we're looking at the standard deviation. So let's actually do this calculation. So I'll just pull up a spreadsheet and I'll show you how we can do this very easily in Excel. So I've done it here for 3 funds. Okay. And basically I have done it for 3 years of data. And you can get this data in a lot of places, right? If you're having trouble pulling NAV data for a fund that you want, just email us and we'll send you the data in Excel. But basically what I did here is I put the dates and I put the NAVs in this column here. And I just calculated the daily return. So simply took the current day return over the prior day return, subtracted 1. And that gets me the daily change. And I calculated this for the 3 years of data, right? And then over here, I've calculated a few statistics. One, what was the CAGR over that 3 years? Okay, so that's the average return over that 3 years. The average daily return, so just the mean of the returns that I calculated, and then the standard deviation, what we talked about. So the way you use the standard deviation formula in Excel, for those of you that want to try this on your own, it's the formula STDEV. And you just select the data and you get the daily standard deviation. So this means the standard deviation of Axis Blue Chip Fund was 1.12%. That means on average, the daily return differed from the mean by 1.12%. Now, if I want to convert that to an annual standard deviation, I need to take the square root of the number of days and multiply it by that standard deviation. So there are 252 trading days in a year in India. So if you take the square root of 252 and multiply by 1.12%, you get the annual standard deviation. And I know I threw a lot of information your way. Stay with me. I'll show you exactly what this number means in a little while. But that's how you calculate it, okay? And these Excels will be uploaded so you can follow the calculations and all. And for anyone that's curious why it's square root of 252, just ask the question in Q&A and I can walk you through exactly why that is. So we got a number. So the number is 17.72% for Axis Blue Chip. If we calculate the same number for the HDFC Gold Fund, it's 14.29%. And if we calculate the same number for the iPru Overnight Fund, it's 1.21%. So what does this data mean? What is the standard deviation telling us? So this is really what it's telling us. It's saying that on average, if you were to hold Axis Blue Chip for a year and you expected the mean return to be 16.58%, the CAGR that it's done for 3 years, there is a risk that it won't be 16.58% based on how volatile the security has been in the past. And the 17.72% tells us how volatile it's been. So it tells you how much risk there is to that return number. So the rules of thumb that we use to estimate the chances of a return falling within a certain range of the standard deviations are as follows. The percent of time that it falls between one standard deviation away from the mean is 68%. The probability that it falls 2 standard deviations away is 95%. 3 standard deviations is 99.7%. So basically, if we look at our data and we say, what is the chances that Axis Blue Chip returns me negative 15% in the next year, right? So negative 15% would be 2 standard deviations away. I can say that that's pretty unlikely. 95% of the time it will not do that, right? So that gives us a sense of how risky a stock is. So let's incorporate this into our spreadsheet that we use, the ledger of assets. So you'll recognize this sheet from the last class. So all I've done here is I've added 5 new columns. One is the standard deviation, which is calculated exactly like I showed you. The second is 1 standard deviation and 2 standard deviations. What is the low and high of the return we can expect? So let's take an example of a large cap equity mutual fund. Let's say that the return expectation is 12%. And let's say the standard deviation we calculated was 15%. So what is this telling me? So it's telling me that 1 standard deviation away from the return expectation of 12% is simply 12% minus 15%, so negative 3%. 1 standard deviation above will be 12% plus 15%, so that's 27%, right? So there is a 68% chance, 2/3 probability, that my return will be somewhere between negative 3% and 27%. And there is almost a 95% chance that it will be between negative 18 to 42% probability of being uh, 2 standard deviations away. So this gives me a sense of how bad or good my return could be. Now, this is not perfect. These are just rules of thumb based on past history. So as we know, past performance is never a guarantee of future returns, but this will give you a good sense of the amount of risk you're taking. So we can see that, for example, here, if I look at the overnight fund, my return could be 3.8% or 6.2%, right? There's not much difference. Why is that? Because the standard deviation is only 1.2%. But if I look at a small cap equity mutual fund that has 25% standard deviation, my return could be negative 10% or 40%, right? So this will really give you a sense of how volatile a holding can be and whether you want to be in that holding or not. Um, so that's kind of what we use the standard deviation for and why it's an important number. You don't want too much of your money in something where you can't take the volatility of that asset. So let's look at an important observation. So if I calculate the standard deviation of an asset over multiple years, what you will notice is that the longer you hold your investment, the less volatility will impact your returns. So if I take an investment that has an average CAGR of 13% and a standard deviation of 15%, and I hold it for 1 year, 1 standard deviation away from that will be minus 2 to 28%. But in the 2-year period, it's 3.19 to 24%, right? 3-year, 5.76 to 19.41. 10-year, 11.31 to 14.49. So what does this tell us? This tells us that if I can hold my investment for a long time, even if it is a volatile investment, that volatility will tend to go away as I hold it for more and more years. This is why holding period is very important in terms of our investing horizon. So can we take this information on standard deviation and abstract it to rules for how we retire and manage our corpus at retirement? So principle number 8, higher volatility investments require longer holding periods and become less and less favorable for retired investors. So as we saw on the last page, if I can only hold an investment for 1 year, 2 years, 3 years, volatility is very, very important. If I can hold it for 10 years, volatility becomes much less important. So can I hold that investment for a long time? In general, retired people cannot hold their investments for as long as people that are not retired. Why is that? Because you need to access your corpus to fund your lifestyle periodically. You may need to sell some of your corpus every year to fund your expenses, etc., etc. And how much that will how much volatility you can stomach are going to depend on things that may impact you personally. So if your corpus is very, very large relative to your expenses and lifestyles, maybe you'll be able to take more volatile investments because you won't need to sell so much of your corpus. How much you have in cash income coming from a pension or from a rental property can also increase your holding power. So you need to think about this from an individualized basis. But in general, when you're retired, your ability to hold investments goes down. Okay, the next principle that we can abstract from this, generally there's a trade-off between volatility and return. And so retirees should factor this into their return expectation in their planning. So because volatile investments carry more risk, then therefore there is less demand for holding these assets. And as a result, the prices of these assets are lower. And because the prices of these assets are lower, they can generate you higher returns. So safer investments will carry a lower return. A perfect example of this is a fixed deposit. A fixed deposit has volatility of zero. You know the return you're going to get. You're going to get your 4% return or 3.5% return or whatever the return you've contractually agreed to get. You know that 100%, but it's a relatively low return. With a stock, you may get 30%, you may get negative 30%, you may get negative 10% in a given year, right? So we know that the promise of volatile investments can be much, much higher in terms of their return potential. So when we think about planning for our corpus, when we are retired, we need to acknowledge the fact that we may not be able to take the volatility of a younger investor who's also got significant cash income. So when we think about the assumptions we make around the rate of return on the corpus, even if the market is giving a, let's say, 13-14% return, you may want to plan for a 10% return because on your equity holdings, because you may need to invest in less volatile assets. So that's an important thing that we should always factor in when we're planning our corpus. So that was a lot we covered. I know it's very technical and mathematical and all. So if any questions, happy to take them in the Q&A. And it may take a couple of watches to get through it and also go through the Excels to see how the calculations are working. But where we're going to go in our next session is we're going to continue with our work on risk, and we're going to talk specifically about diversification. Why does diversification lower our risk? What risks is it able to lower and what risk is it not able to lower? Can we quantify how much diversification will help on our portfolio? And how do we know if we're really as diversified as we think, right? What are the common traps we can fall into where we think we're diversified, but we're really not diversified? So that's what we'll cover in the next session. With that, I'll open it up for Q&A.
Yeah, just a minute.
And as always, we'll be posting the Excel on the sheet on the website.
There's a comment. 2020 was an abnormal year, so normal distribution stats are not correct.
It's an interesting point. It definitely was a unusual year, but I'm not so sure that you can always do things like exclude unusual years from your data, because the reality is no one expects the unexpected, and you need to factor some of the unexpected into your calculus also, because life is seldomly ever smooth and rosy. So whether it's the housing crisis in 2008, or it's the internet bubble bursting in 2001, or it's the Asian debt crisis in 1997, or it's the Japanese bust, or it's the Russian debt crisis, or it's the Great Depression, all of these things are very, very unusual and they catch us by surprise. So while we should not take this 1 year and use it as the basis of our calculations for everything, we should also not exclude it completely from the analysis. My suggestion when you're calculating statistics is take a broad time frame that includes good markets and bad markets. So maybe if you took 5 years, right, you'll have 4 years of a bull market, 1 year of a dislocation and recovery, that'll give you a good sense of how your stock or your mutual fund will perform under various markets. You don't want to just throw this year out though.
Okay, so there's a question, how did you calculate multi-year standard deviation?
How did I calculate?
Multi-year standard deviation.
Okay, so basically this is a good question. So essentially, when I have a daily standard deviation, the way that I convert it to a annual standard deviation is I essentially take the square root of 252, which is the number of days, and multiply by that standard deviation. That's generally the formula of how it works. And the reason it works like that is you're summing the variance of all these numbers up. And when you're summing the variance, you're doing it 252 times. And when you're actually calculating the standard deviation, you take the square root of the variance. That's why that square root comes. Um, so when you're doing a multi-year, let's say the standard deviation of my mutual fund is 15%, right? And I want to calculate the standard deviation of that portfolio for 3 years, right? So the standard deviation is going to be that 15% times the square root of 3. Okay. Now that's going to give me some number, probably, let's say that's going to be like 22%, roughly 23%, something like that. Okay. Now that 23%, right, when I calculate that in terms of an annual rate, right, that's how I get the annual standard deviation for multi-year. So I take that 22% and I add it to the multiple, and I take the CAGR of that multiple, I get that number. So the Excel file that we're going to upload is going to have that calculation also. So you can go to that tab and see exactly how I calculated it.
Okay. Normal distribution does not mean a normal year, does it?
Normal distribution, no, it does not mean a normal year. Absolutely. A normal distribution basically is a pattern that a lot of people see in random events that occur in nature. And the jury is out whether stock prices are normally distributed or not. But normal distributions factor in the unexpected also, correct?
Okay. How different is the calculation for equity shares in comparison to mutual funds?
The calculation's exactly the same. It's exactly the same. The exact same formulas I used will work with stocks also. You just want to use the stock price on a daily basis, and it'll work.
Okay. There's a question on, is it possible to make this very simple for senior citizens?
Okay, I'll do my best to make this really, really conceptual and simple. So let's say that, and maybe I'll try and do this by analogy. So let's say that I was playing darts at the pub, and while I'm trying to hit the bullseye on the dartboard, I know that my skill level is going to cause me to go all over the place, right? Sometimes I'll hit the bullseye if I'm lucky. Sometimes if I'm unlucky, I won't even hit the dartboard. Sometimes, I may hit the person next to me if I'm really, really bad at darts, right? Now, if you take a champion dart player, right, he's going to be able to hit that bullseye much more frequently than me, right? But even for him, he's not going to hit that bullseye every single time, right? There's still some uncertainty. Maybe he'll miss a little bit here, maybe he'll miss a little bit there. And if someone bumps him while he's throwing the dart, maybe he'll also miss the dartboard completely, right? So when we try to talk about how likely something is to happen or isn't to happen, the concept that we look at is what is the volatility of these two things. So volatility basically means how how much dispersion there is. So for me as the dart player, there's going to be a lot of volatility, right? For the champion dart player, there's going to be a lot less volatility because they're much more accurate and consistent. So we're doing the same thing with stocks and mutual funds here. We're basically saying how much does the price of this thing move around? Is it moving around a lot every day, going up 10%, down 10%, up 5%, down 5%? Is it volatile, or is it going up maybe 1%, down 1%, up 0.5%, down 0.5%? And that's kind of what we're doing. We're trying to see, is this a champion dart player or is this an amateur dart player? And the point is, the standard deviation allows us to measure how consistent or not this stock is. And that's really what that number is telling us. If the standard deviation is high, it's telling us it's not a very consistent player. If the standard deviation is low, it's telling us it is a very consistent player. So when we calculated those numbers for the overnight fund, we got a number of 1.2%. So that's telling us that the return barely moves. 1.2% movement on the return is very, very low. When we looked at the equity funds, we saw a standard deviation number of around 17%. So that tells us that the movement can be very high. Sometimes it'll hit the bullseye, but if it misses, it may miss by 17%, right? So that's kind of what we're trying to do conceptually and why this number is very important. So
Okay.
hopefully that explains it a little bit.
Yeah, there's another question on the compare tab in Bharosa.
Sure.
And it is that in the under compare in mutual funds, you have the Sharpe ratio.
Yeah.
How does that relate to standard deviation?
Good question. So the Sharpe ratio essentially includes the standard deviation as part of its calculation. So it's a ratio of two things. It's a ratio of the return relative to the standard deviation. So it's basically measuring how much risk adjusted return is this mutual fund delivering. So things that have a lot of high Sharpe ratio, it means you're getting a lot of return for every unit of risk that you're taking. So you want to see things with high Sharpe ratios.
Okay. So, in some sense, if a person just didn't do the calculation as far as mutual funds is concerned and looked at compare tools, would that suffice?
Yes and no. The main point here is I could have a very good Sharpe ratio. Let's say my Sharpe ratio was the best in the universe in compare schemes, but my fund was very, very volatile. Okay, so I had lots of standard deviation in my return. If you were an investor that needed to sell this investment in 1 year, it would be very hard for you to invest in my fund, even if my returns were very good. So I'll give you an example. Let's say that I know that I'm going to need to sell part of my corpus to fund a major operation next year. Okay. And let's say I have a 10, it's going to cost me 10 lakhs. And I am looking where to put that 10 lakhs to invest it because I only need it in a year. I find a fund, right? And that fund is telling me I may get a 20% return on that money. That sounds really good to me, right? 20% return is exceptional. So, but when I look at the standard deviation of that fund, what I realize is the standard deviation is 30%. What does that tell me? That tells me that in 1 year, the return, if it's as volatile as it was in the past, it could be very easily negative 10%, right? So if you look at those calculations that we did in the ledger, they'll help you get a sense of how the return could look in a year, right? So I can't take the risk that that 10 lakhs becomes 8 lakhs because I need to fund that operation, right? So that investment would not make sense for me, even though the Sharpe ratio may look good, right?
Okay. And related to this is another question or comment which says that so a high standard deviation is also positive in the sense that the asset can give you higher returns, provided, of course, that you have the ability to hold on to the asset.
Correct, correct. And that's a general relationship. It's not a specific relationship, meaning that just because an investment has a high standard deviation, it doesn't mean that it will give me a higher return. It means that it should give me a higher return, but it very well could just be a very bad investment, right? And so you always want to be diversified, and you want to look at things holistically, right? Um, but yes, absolutely. A strategy that a lot of people use to get good returns is they realize I don't need this money for 20 years. If I don't need this money for 20 years, I don't care where the price of this company is today, tomorrow, day after, 1 month from now, 1 year from now, even 2 years from now. All I care about is this company is going to do well in the long run. So they look for companies where there's lots of volatility, so that many investors cannot hold this company. But because I can hold my money for 20 years, I can hold the money just fine. And I'm not going to care where the price is. So absolutely, that can be a very good strategy for people to look at. But you gotta look at everything. Don't just look at standard deviation and say, okay, I want to go for this.
Okay, there's another question then. There's another ratio called Sortino. Why not use the Sortino ratio?
Yeah, so the Sortino ratio is basically looking at only standard. It's basically very similar to the Sharpe ratio, but it only includes volatility to the downside. You could look at it. It's a less commonly used number, so you're not going to see it in a lot of places. But it's a fine measure as well. Sharpe ratio is just more commonly used, and so easier to benchmark.
Okay. I don't think there are any more questions. So I think we can end this session.
Sure, but before we end, I just want to say for people that are having a little trouble understanding this is pre-advanced. If the only thing you really need to internalize here is that volatility is measurable by something called the standard deviation. Using that, you will get a sense of how much a return could potentially vary in the future. So if someone is telling you, I'm giving you a 10% return, right? If the average return of a mutual fund is 10%, and you look at the standard deviation and it's 15%, all that's really telling you is that there is a high likelihood that the return could be as low as 10 minus 15% or as high as 10 plus 15%. If you just remember that, you're going to do reasonably well in understanding the concept.
Got it. All right.
But yeah, this is one of the trickier things to internalize. So hopefully people get it. If not, write into us at advisory@bharosaclub.com. Happy to spell this out, answer any questions there are on this, because I know this is a tricky issue. And it's a very important one to understand also. So please write in if there are any any confusion on this. So next time we're going to look at diversification, and then I think we'll start moving into actual real life examples of how to make decisions. So I might go into case studies of, look, this is my situation, how am I going to plan my corpus, right? So that'll be a lot of fun of how to use these concepts to actually make concrete decisions. And then we'll go back to some theory and go back to case studies, etc., etc. So great. Good. Thanks for joining us, and see you in 2 weeks. And Happy New Year again. Bye bye.